Welcome to today's online seminar series broadcast by the Environmental Bankers Association. I'm Georgina Dannatt, one of the officers or staff members of EBA. And today we are going to give you a little bit about what is EBA for those of you who are new to us, and then move into our presentation. EBA is a trade association. We're now in our 25th year. We're focused on education and information exchange between peers. Our members are bankers, environmental risk managers within the bank, consultants, attorneys, data companies, and insurance providers. We have 2 conferences a year, including one that's coming up in January in New Orleans. Monthly calls, and a website where you can find more information. This session is being recorded for people who want to ask questions via the Q&A box that's available throughout the presentation. We also will, if time allows, open it up at the end for verbal questions. Our speaker, or our conference, online today is Environmental Banking 101 is the topic of our seminar. And our speaker today is John Rybak. John Rybak is a Senior Vice President with BB&T Bank. He has 27 years of environmental due diligence experience at 4 different regional banks. He has a BA in Environmental Studies and an MBA. His focus is on risk management and risk awareness for the bank, and he's heavily involved in talent selection, coaching, including he does an annual roundtable for vendors and with his review staff, which is unique in the industry. John's located in Charlotte. He'll also be assisted today by John McGinnis of Comerica Bank, who is in Costa Mesa, California, and Michael Cole of SunTrust Bank in Raleigh-Durham. So go ahead and take it away, John.
Awesome. Thank you, Georgina. This is John Rybak, and one thing I'd add with questions is we will get to as many as we can, but if we cannot get to your questions, please do not be offended. This presentation is intended to be an overview and will be followed up with additional EBA online webinars that will dive deeper into topics. This presentation today, the purpose is to clarify why lenders need an environmental risk program. There we go. Is to clarify why lenders need environmental risk programs, to highlight some of the regulatory influences, and discuss the risks the program should cover. We will also go into what are some of the essential considerations of the program. Then we will discuss how to implement some of the aspects of a program. This is a high-level presentation, and again, we'll go in deeper in future series. But the how here is referred to as the details, and it's often the hardest part of implementing your program. But as our CEO says, once you understand your why, you can endure the how. This book here referenced on this page and also in the emails that went out by Simon Sinek, Start With Why, is a key to success to understanding your why you're in the job you are, why your job exists, and why it matters. The audience today, this can be valuable information whether you're a lender or a consultant. It's designed to discuss some of the inner workings and nuances of an environmental lending program. So for lenders, the connection is obvious. If you're a seasoned lender, it can reinforce what you already know and strengthen the reason for your existence to management. If you're a new lender or developing a new program, the value will be obvious and designed to help you justify to management why you would need an environmental program. If you're a consultant, the connection would be less obvious. But we can always learn from those we work with. This will give us some insight into your clients and their challenges. The better you understand your clients, the better you can serve them. If you have clients developing new programs, use this information to share with them. Offer guidance and assistance in working through the process. We will now discuss the next 4 points as we develop the why we should have a policy and program. FDIC in 1993 was the first regulatory agency to come out with a guideline for environmental policies with banks. And it essentially said that a lender should have an environmental risk program. Then in 2006 was this bulletin, which is a financial institution letter that was issued. And this was issued in response to changes to the Comprehensive Environmental Response Compensation Liability Act, known as CERCLA, which discussed all appropriate inquiry for borrowers and developers of property. That AAI rule basically established the minimum due diligence that borrowers should do to protect themselves from liability. And this FIL letter, particularly to lenders, said lenders should have a program, check, that was the same thing as 1993, but that program should evaluate the risk of impact on collateral value and should also evaluate the risk of impact for lender direct liability. This bulletin further states that programs are tailored to the needs of an institution, left up for interpretation. Another guidance document that came out is from the OCC. These are instructions for their bank instructors when evaluating our institutions, and therefore should be part of our program. These instructions include looking at how a bank handles its credit risk, if its policies evaluate for contamination, possibly decreasing the collateral value or the borrower's ability to repay the loan. Also, compliance risk. Looking at that, failure to ensure compliance risk with laws and regs can generate significant liability to the bank. Underwriting loans of specific property type, as different property types bring heavier weight in environmental industry, and non-suspect properties may not get as much scrutiny. Also, to evaluate the quality risk program. What they're talking about in this document is the board for the bank evaluating and having effective policies like environmental risk management policies. We'll talk about that more a little bit later. There are also some other guidance documents and institutions out there like the Office of Thrift Supervision that apply and lenders should also be aware of. So let's consider why. Why are these regulatory agencies coming out with guidelines and statements? Knowing the existence of these guidelines, guidance documents, and understanding why they're written can help you launch a new program or just sustaining your current program. We've all probably heard of fleet factors, which is the first direct liability case for a lender. In 1996, because of fear of lending on these properties, CERCLA was amended to include a lender liability exclusion, but state laws can still hold banks liable. So why are they giving out these guidance document letters? I believe because they are responsible for regulating banks and establishing safeguards and keeping the public money safe. Their focus on environmental risk is to make sure banks remain liquid, have enough assets and money to cover debts, and collateral value and direct liability do affect liquidity. So if they consider environmental risk to be significant, then our institutions should consider it significant as well. Understanding lender risk. Credit risk. Will there be an impact on the borrower that they will not be able to repay the loan because they have to pay for environmental cleanup or fines? Collateral value. Will the impact to the property itself reduce the value to the point where you're not able to get your money back? Regulatory risk, fines and compliance. If you take it back, are there fines or compliance actions you have to either pay or take and spend money to keep up? Reputational risk. What is the reputational hit to the bank for owning a contaminated property, especially if there are third-party impacts that's impacting the adjacent properties, et cetera, or communities? Lastly, secured creditor, which is a defense under CERCLA law, does not cover everything. It does not cover underground storage tanks. It does not cover stormwater issues for construction sites, and we've got a case study at the end for that. It does not cover chemical storage and ongoing releases. Let's take a look at borrower risk. So understanding the borrower risk. Is the asset value really what they think it should be for the purchase price? Are they preserving their defenses under AAI? Are they taking on liability that they don't know about? And consultant insurance is something to think about when performing due diligence. This is a supporting factor for doing the due diligence beyond these three. It's consultant insurance. While I'm not a proponent of legal cases, insurance is rarely relied upon. Getting a phase one does provide you some measure of protection under their coverage if items are missed. At the very least, the consultant may have a duty to correct a missed situation. Okay, we are now going to segue this 1/3 through the program of the how, the what, why, what, and how. We're going to segue to questions, of which I'll ask Michael and John to chime in on. All right, so guys, we all have clients. So who do you define as your client? Michael or John?
Sure, I'll be glad to chime in. Yeah, I'm sorry. Yeah, we definitely at SunTrust we see our client as the final approval officer or the credit officer as our first client. Our second line client would be the loan officer or the account officer, the relationship manager. That all those terms being kind of semantic to each other, so those all being the same person. And then of course our borrower is our third line client. And in that order for specific reason. Number one, our reports, our reviews are really written for the final approval officer or credit officer to be able to make that decision as to whether or not to move forward with the loan. They're, of course, taking in information other than just the environmental conditions on the site. They're also looking at the appraisal and the borrower's history, their financial strength, et cetera.
Okay. Thank you, Michael. John, anything to add to that?
No, I just say we consider, the first and foremost, our client is we're in-house. We're here to protect the bank's assets, so the bank itself overall is the client. And I guess in an old-fashioned sense, it's the depositors' assets of the bank that we're protecting and liability-wise. And as Michael said, down the order, we're on the credit risk side, so we're that side of looking at all the credit risks, and environmental risk is one of those. But we're also here, we have a service function too, so we're helping the loan groups and the loan officers understand environmental risk and what they need to do to get through that.
Okay. And that almost ties into the second question I have. In your opinion, John or Michael, what is the greatest value your department adds to the client?
Well, we our greatest response is when a problem does come up and there's some environmental risk issue, liability, or a pollution condition on a property, we help the loan officer find a solution, and it's in their borrower's interest as well, which is, as Michael said, like the third line client of the bank. And especially if we're standing in the same footing as a buyer of the property who's the borrower, they'd want to know as well what they're getting into and can use that information maybe to negotiate a sales price and things like that.
Okay. Michael, anything there to add?
No, I mean, I agree 100%. Certainly, of course, we're a protection function of the bank, so we're trying to make sure that the bank is making loans that are sound risk and that we fully understand the risk before making those loans and all the risk, including environmental conditions on the site. But yeah, that definitely, certainly we're problem solvers, and that's, we try and solve the issues or solve the problems in order to be able to make the deal work as well, make it profitable for both the bank and our client, our borrower as well. So those are definitely components that, while separate, are also related as well and connected.
Okay. Thank you.
John, I would add that we're technically skilled to understand what due diligence, and I know you'll get into that later, of what environmental site assessment reports we're reviewing. So we can understand if what's a good report and what's good due diligence and what's lacking, and we can try and find out information that's required.
And I think that was a point, John, that we had talked about previously, calling it a level playing field, identifying quality reports versus unqualified reports and rejecting them. So creating a level playing field among the bankers and the lending institutions is also a benefit that we bring. Recognizing that the bank is your primary client, but there's also some benefit to the communities you work in. So what are some of the differences you guys make in the communities you work in?
Well,
one of my answers, go ahead, John.
Okay. Well, in a sense, regulators don't have the time or the budget to go out and find every pollution condition in a town. So, right. Lender-driven due diligence that often is finds that and gets that, and if needed, remediates it during in some sort of real estate transaction. So, in a benefit, we're sort of cleaning up your neighborhood parcel by parcel or loan by loan.
Right. Also, another point that I thought of was, because we have a program, because we have consultants and trained up staff, perhaps we're able to do deals that lesser institutions are afraid of, because we're able to manage the risk better and understand the risk. So being able to put through a brownfield deal or an idle property, abandoned commercial property, industrial property, is also a community benefit. So, okay, awesome. I'm going to move on unless there's any other comments. Okay, moving on to the what section. Thank you guys for that. So we have a better understanding of why now. We're going to transition to part 2, which is to focus on what. What should be in a program? Policy. Your policy is like a roadmap for managing risk. A roadmap provides both directions and as the bottom right corner shows, caution. Staff. Consider, how many people do you need on your staff? What is their education level? Do you need to have professional geologists, professional engineers? Do you need to have people with banking knowledge? What is the experience level that you need or desire? Less than 5 years, 5 to 10, 10 plus? Think about, will this staff be merely technical, or will they be part of the credit team? Because it will require a different skill set and could change how your policy is drafted. Consultants. I believe consultants are the foundation of your program. How many consultants will you have, and what are their experience levels? Quality program. We talked earlier about the OCC looking at the quality program, and what they are discussing is whether you have the appropriate risk policies in place in an institution. And that is part of it. But also at our level, we should adopt a quality program for our reviewers and for our consultants. How else will they know how to improve if you don't provide feedback? We need to let them know that when they do a good job so they can repeat it. We need to help them recognize when and where they need improvement so they can grow. Consider what's important to you in the relationship, measure it, and give feedback. Understanding environmental risk. Our mission should be, as Michael and John had stated, to help close deals. So, how do you go about accomplishing a mission? You order an environmental report, you evaluate and qualify the risk, and you develop solutions. Okay, so that ends the what part. Let's go on to some questions. Once again, we go to John and Michael. Number 1, do you prefer small regional firms or large national firms, and why? Environmental consulting firms, and why?
Yeah, I think that a good mix is probably best. When you have a national firm, certainly our bank does a lot of national lending, so especially portfolio lending, where we may have 200 sites that we're doing in one loan, 200 sites securing one loan. It would be very difficult for a small firm to be able to handle that, especially since many of those sites may be in multiple states. Even a regional firm could struggle with that. So certainly you need national firms on the approved list, but also you get a lot of advantages with smaller firms, a lot more consistency oftentimes with smaller firms as far as the consistency of the format of the report, of even what's being called a rec each and every time. So I think having a good mix is really important, having small local firms for some areas, that especially areas that your bank may be highly involved with, and then regional firms in the region that your bank works in, and then also the national firms are a must, especially for our big portfolio projects and projects outside of our footprint.
Thank you, Michael. John, what is the value of regional firms and local knowledge? Can you explain that?
Yeah, we have a similar take on what Michael just said, because we have a regional bank with 3 major market footprints throughout the country, but we often will make loans in every state, so the national firms come in to play there. But we have a smaller local state firms as well, because they're maybe more familiar with state regulations in various states throughout the country, and may have a rapport with some local regulators as well, I often find. So we have a mix of both too, for the same reasons Michael just said.
Okay, great. And John, what would you consider to be a manageable number of environmental consultants for your group?
Again, we've sort of broken down the country into three regions. So we have a list in each of those regions of approved consultants. So there no more than a dozen in each seems to be our comfort level, maybe 8 to 11 often. So and it it does vary from year to year, but that's our thought process.
Okay.
Anything larger might be a little bit too unwieldy, and anything smaller, you're not getting the coverage you might need.
Thank you. Michael Cole, what do you consider a manageable number of firms? And share with us why you go with the number you go with. And I think you had talked about, biggest clients, so to speak, as keywords.
Yeah, I mean, when we first started, when I first started at SunTrust 13 years ago, we had an unmanageable approved vendor list. It was pretty much every loan officer brought their own vendors with them onto the list, and it was hundreds of consultants, most of whom would only see 1 or 2 jobs from our bank a year, and we had this odd problem that we were getting projects in late all the time. I mean, almost a third of our projects were coming in past due, and of course, if we're only giving a consultant 1 or 2 jobs a year, and they've got other clients that are giving them 5 to 12 jobs every week, we're going to be taking a back burner to those firms that are to those clients that are doing so much more business, and understandably so. So we took a different approach, and we really scaled back our approved vendor list to under 20, and in fact, really about a dozen total. And then we became one of the biggest clients of each and every one of those firms. We became an important client for all of our consultants, and by doing so, we were able to, sort of lean on getting more premium pricing, on making sure that projects weren't coming in late, because if a project comes in late and it's unexpectedly come in late, we just won't give them a project for the next 3 weeks. And if you're getting 10 projects from us a week, a 3-week freeze is a significant hit financially. So it really caused us to be able to get better quality reports in on time. We were able to specify what format we'd like the reports in, and becoming such a large, important client of each one of those environmental firms made it a lot easier to get those issues addressed and be able to get more uniformity to the products we're getting.
I think that's a fantastic answer, and we've also experienced that benefit. And I think you had mentioned earlier being relevant to that consultant, and I think that's important for service and quality and consistency. So how do you guys handle report ordering? Does the bank order the reports? Can the client order the reports? Does the client, if they can order them, have to order off the approved list, or can they order them from anybody?
Yeah, we allow, we prefer the bank, the loan officer would order the report. We allow the borrower to, but they do have to order off our approved vendors list.
Okay. Michael?
We also strongly prefer to order our own reports. We try and encourage them to do so, just simply because the number of reports that we get from their unsolicited reports that get rejected is much higher, of course, than it is when we order reports from our own consultants who understand our expectations and know the quality that we're expecting and what we want in the report. However, we do accept borrower-provided reports or unsolicited reports, and we don't specify that they absolutely have to come off our approved list. After all, there are some really great consultants. With us having such a small approved list, there being thousands and thousands of consultants out there, there's some really great consultants out there doing good work. So we review the work before determining whether or not it's something that is or is not acceptable.
Great, thanks. Okay, lastly for this what section under staffing, what do you look for in a new hire for an environmental review officer for the bank?
I'm sorry, John, can you repeat the question?
Oh,
yes. What are you looking for when you're hiring a new review officer for the bank?
Oh yeah, that's a great question, and really, honestly, it's a mix of things. It depends on what I have on staff. For one thing, I want to build a team, and I don't want my entire team to have the exact same background as the last person I hired. So it's good to have some people who have a strong technical background as part of our team. Other people I would look for that have more environmental risk experience, perhaps, instead of just. It'd be great to have somebody with some regulatory experience. So what you really want to do is you want to build a team that has a mix of different experiences and backgrounds to try and help. And then when you have a problem, a project that has a challenge to it, you can tap into all the different talent that you have on your environmental team to try and help solve that problem.
Okay, thank you. John, anything specifically about personality, communication skills?
Yeah, I would just add, in addition to all the technical experience and the ability to write a phase, or experience in writing a phase one from start to finish with the field work and phase two experience, like Michael had said. One of the things I was asked when I interviewed for this position years ago was, how would you deal with an irate loan officer? And that's part of the position is having a calm and reasonable personality to explain things, to a person who's all they're interested in is trying to make their loan and their quota that week or month. So and so that's part of the staff in-house of an ERM group. You have to deal with the in-house issues as well as the consultants too on some occasions. So that's part of makes a good ERM officer.
Yeah, I would agree with that calm personality. Often you have to explain to clients, to their consultants, to borrowers, to attorneys, why a risk is a risk. And it doesn't always go well because somebody's not making money if they don't do a deal, whether it's the buyer or the seller, et cetera. So that's very, very key. Okay, awesome. Thank you. All right, so we've talked about why do we need a program? We've talked a lot about what are some of the things that goes into a program. And now we're going to transition to the third part, which is how do we go about some of this? Training of staff. We're going to talk about types of assessments to use. We'll talk about risk mitigation options. We'll talk about bankers and why a risk matters and what is a REC, and we'll define that. Also talk about training of consultants, and you heard some of John's comments and Michael's comments, a manageable number of firms. I would add to that, define your expectations for your consultants. In our case, we consider them an extension of the bank. We train them to consult on each project. Don't default based on the last one. Think it through, and we provide them a feedback loop as we've already discussed. In BB&T's culture, it's known as the coaching model, know, show, grow, and it never stops. So, types of assessments. At the very base of this pyramid is a database / environmental questionnaire. A database is commercially prepared product that you can purchase, and it gives you a summary and detailed dump of federal and state databases. It may not hit each and every database, but it's a pretty good screening tool. That can be reviewed in-house. You can hire consultants to review it as well. The environmental questionnaire, that is a checklist that is done. It can be done by the property owner, by your borrower, your banker. I suppose you could also hire environmental professionals to do it as well. It typically goes through a series of questions with checks. It may or may not include a site inspection. A TSA, a transaction screen report. I referenced down there the guidance document ASTM 1527 for you guys to research at your leisure. And that is a consultant prepared report. They will go on site and they will inspect the property. They will do a database and fill out a version of a questionnaire as well, and provide that to you with an opinion. The next step is a phase 1 report, which is also a consultant prepared document. They also go to the site, they do the database, they are going to do more in-depth historical research on the property and do interviews of the property owner as well. Includes photos, interviews, and opinion of risk. Agency file information is also evaluated. If risks are found in one of these lower tier due diligence tools, a phase 2 might also be recommended and completed, and the reference standard for that is E1903. A phase 2 is when you go out to a site and you take soil or groundwater, or in these modern days, soil vapor samples, submit them to a laboratory. So you're actually testing the risk that you have identified in the preceding due diligence tool. And then that's also a consultant prepared report and comes back in for review. Okay. So here we have risk mitigation strategies. Environmental options could include doing the phase 2 additional due diligence once a risk is found. It could involve remediation or cleaning up contamination in the event of foreclosure, or perhaps a risk is identified, but it's considered de minimis, which means minor. Perhaps there's a no further action letter issued by a state agency that you're comfortable with. Or perhaps there's engineering controls like 1 foot of clay liner fill over top of the risk, or parking deck, or asphalt, or apartment buildings with agency approval. Those would be options for us to consider in evaluating what to do. There are other tools, too, that we have used before, but each bank needs to decide what tools they will use and how. Each credit is different, warranting different approaches. Some of the things we've done is we've rejected the collateral, or you can ask for substitute collateral, especially if you're dealing with a portfolio. When you have 24 gas stations you're looking at as a collateral deal, you could substitute the 21st gas station out and go get a different one that doesn't have as much risk if you choose. You could escrow money to cover the issue. You could hold back loan proceeds or go seek insurance. Or you could even enter borrower agreements where they'll remediate the site. Maybe post-closure, they'll clean up the site. And, of course, you want to get indemnifications from the borrowers. Training lenders on what is a REC and what is a risk. A REC is a recognized environmental condition. It's an industry term meaning a risk was identified per the ASTM standards. Banks often have concerns beyond the typical RECs, and we'll get questions like, but the report did not recommend any additional investigation, so why should we be concerned? Sometimes there will be risk beyond a REC. We talked about stormwater issues and others, or sometimes the report doesn't have recommendations. It may have a REC identified, but not a recommendation on how to manage that REC. Sometimes bankers will ask, I've got an NFA, why is it not adequate? An answer to that is you need to understand the basis for that NFA. Did it actually investigate the whole site and all the risks that you're looking at, or was it limited to the northwest corner and you've got other concerns at the property? Another question that pops up, why can we not rely on seller prepared reports? We don't rely on those because there could be an undue influence on the results if it's a seller prepared report. And these are all things that we go through with our bankers on a regular basis. Oh, in January 2019 in New Orleans at the Environmental Bankers Association meeting, there will actually be a session called the Life Cycle of Environmental Learning led by Catherine Peacock with Partner Environmental. She's a veteran in the industry and well respected. This is a panel with 5 lenders discussing their training programs with lenders in their institutions. So for those in attendance, this is definitely a session you will want to check out. I believe that is early Tuesday morning session. Okay, consultants. So what is a manageable number? I think that the consultants are the foundation of your program. So invest your time wisely here. Again, do you want to have few versus many? Do you want to have regional versus national? Think it through. Develop a relationship with your consultants. Cultivate their trust. If you're investing your time developing relationships and cultivating trust, the information you get back from consultants is going to be better than firms that you don't have relationships with that you may use once a year or twice a year. So if you want great information to make your decisions on, my recommendation is to follow that model. Rely on consultants for direction. Communication is an asset. Make sure that your phone lines are open to answer their questions as they come up on the relationship or on a specific deal. Set the expectation for recommendations. We don't just want to report. I want to know how significant this risk issue is in their opinion and what they recommend we should do about it. They know me as a client well, and they're maybe the only one that goes to see that property. I'm definitely not going to see the property because it could be a very remote location. We need their recommendations. Perhaps I need them to go out there to conduct an additional investigation based on their recommendations. So, as a result of your program, you should be able to answer these big questions. What is the cost of the cure versus the asset and the borrower equity in the deal? In the event of default, would the bank actually want to own this property? If we did want to own this property because of the cost of cure versus asset value, et cetera, what are the potential liabilities? What is the regulatory liability? What is the third-party liability? Am I contaminating my neighbor? Is my neighbor a shopping mall or residential property? And what would we have to do? Are there any post-foreclosure actions we'd have to do if we're to own the property? Another interesting one, real or perceived, is market stigma. Is there a potential market stigma, environmental market stigma on this property that could reduce the value? That concludes our section on how, and I'm going to go once again to our expert panelists with questions. So, John and or Michael, what are potential policy pitfalls?
Well, I would say, well, the policy is going to lay out when and how and what level of due diligence. That's the I guess the major reason you have a policy and how to protect the bank, what the bank's tolerances is. So, for example, above a certain amount, you might have to do a full phase one automatically, and anything in determining what's high risk and what's required. I think the pitfall is you can't always think of every scenario that's going to happen. So there's a lot of gray areas in environmental risk management. So we usually have a clause that says, consult the environmental risk management group, something to that effect. So the loan officers know if they fall in between, they'll know to ask us, and that's again why we're here, to advise and walk them through what they need to do.
Okay. And I think, John, that answers why is it important to be flexible in your policy, and I think you answered that as well. Michael, what is a policy pitfall?
Yeah, I mean, I'll tell you one that I think is really easy to fall into when you first create a policy, and perhaps it's a hard lesson that's learned, is when you create a policy, understand that there's going to be some exceptions to that policy. So create a policy that's very generalized and that encompasses 80% or even 90% of all the different projects or situations that you may run into, but understand that there's going to be at least 10% that you can't account for. So when you create the policy, keep in mind when you hear hoof prints, think horse, not zebra. And by that I mean think about your general situations that you're going to run into 90% of the time, rather than the oddball situation that could potentially or possibly come up. And then create a means for those exceptions, a way that you can handle exceptions and a way that you can document those exceptions properly. So by encompassing 90% of all your projects into your policy and the way the policy normally works, you're not creating a confusing amoeba-shaped policy. You're creating something that makes perfect sense and is more generalized for the way typical projects run. And then you've also created a means for how to handle the exceptions to that rule.
Good. Thank you. What is your bank's position on reliance letters? Because I know those can be issues within policy.
Yeah,
Do you require them?
Require reliance. Yeah, we'll always require reliance letters for unsolicited reports from a non-approved vendor or reports that were done for another entity.
Michael?
Yeah, we require them as well. Honestly, though, if we have a reliance letter format that we would like the vendor to fill out and utilize our reliance letter when they give it to us. But oftentimes we run into consultants that are not comfortable with and want to put limits on their liability. In those situations, it's better not, we found, at least for our bank, that it's better not to have reliance on the report than to sign an agreement that gives us limitations on our liability entirely. So, in other words, we have an exception to that rule as well. We will accept reliance on reports. We'll try and seek reliance on reports under our terms, but if we can't meet our terms, then we'll go without the reliance letter.
Okay, gentlemen, we are going to transition into red flags and a couple case studies. Is there any last comments you'd like to make as we close out the question section? And if not, that's totally fine. Okay?
None here.
Very good. All right, very good. We're going to transition into 3 situations with red flags that we often deal with as a result of our due diligence process. Here, dry cleaners are a very frequent issue that we run into. One consultant I was dealing with had done an internal study that they found subsurface impacts at 50 to 70% of the cleaners that they were doing phase 2 sampling at. So that's not 50 to 75% of all cleaners, but when they did a phase 2, over half the time they were finding contamination. So risk factors to think about would be the occupancy, the duration of occupancy, the type of machine being used. Is it a closed loop system or an old style machine? What is the housekeeping, the compliance history, and depth of groundwater. The reason depth of groundwater is important is because dry cleaning solvents sink quickly down to groundwater, and if you're dealing in a arid place, groundwater impacts are less likely than a place like Florida. Taking a look here, here's a gas station, and things to think about with the gas station is the phase 2 scope must identify all the risks that we find on site. Often borrowers will come over with a phase 2 that does some testing, but not enough to actually cover the site. So not every phase 2 is adequate. You need to take a look at it and make sure it does cover the risks you're interested in. There's the possibility, it used to be an auto repair shop, floor drain septic system, and that area wasn't tested, or perhaps there were older tanks in another location that weren't tested. Many things to think about. In looking at a UST, think about age of the tank, construction, is it bare steel or is it fiberglass reinforced? What are the compliance and leak detection records? And what are the maintenance records? All those will go into evaluating that risk. Hazardous material storage. Think about, is it in secondary containment where spills could be contained? Is it nearby a floor drain? Is it sloppy? Is there cracked concrete beneath it? Or is housekeeping impeccable and neat and orderly? All that goes into the decision. Here's an above ground storage tank that is not located in secondary containment. I guess one could argue the garage floor itself would be secondary containment, but you can see a crack in the floor and heavy staining underneath, and housekeeping here is not good. Here are some of the industries we commonly find having these type of risks. Print shops, machine shops will often use solvents, hazardous waste that needs to be evaluated. Same thing with circuit board manufacturing. Auto repair servicing has oils as well as solvents. Ag uses come into play for us when they're being redeveloped into subdivisions, because you're mixing former agricultural chemical use with residential occupancy, and that's a risk that you need to consider. Sites that have had long-term industrial occupancy are a high risk as well. Sites that have septic systems, oil water separators, and oil and natural gas wells all would raise red flags. We are almost done, folks. We've got tips for smooth sailing in 3 quick cases, so should be wrapping up in the next 5 to 10 minutes, and then we'll start on questions. Helpful hints. Start the environmental review process as early as possible. I found out from one of my peers in another industry, they read existing borrower prepared reports right away to make sure that it's even going to pass muster. If it looks like junk in the beginning, they let their banker know right away. They may not finish the review quickly, but they start those real quick to rule out the bad ones. Give your consultant good information, good contacts. Provide all available environmental documents to the consultant. For agency work, make sure you use consultants that are familiar with Fannie, Freddie, or SBA. And then this one goes back 2 or 3 decades. I remember one of my bosses telling me, the environmental review or the environmental department should be viewed as a resource, not a roadblock. People want to use resources. People find ways of to get around a roadblock. Case studies. We talked earlier about stormwater. Why is stormwater an issue? Well, anytime you disturb the earth and you put up a development, you have to follow certain regulations to make sure the silt and sand do not enter waters, streams and creeks and whatnot. If you come across a foreclosure on a residential development and the borrower did a bad job of stabilizing the site, you may come across something like this. We had about 200 acres were clear cut during the last major recession, and we had 40 retention basins on site, so 40 basins that caught mud and dirt before going to streams. They were all bursting and overloading with silt and sand and sediment, and we spent a massive amount of money stabilizing, regrading, and seeding this. If we failed to do that, you could be subject, even as a lender, to up to $25,000 a day fine per violation, and we had dozens of violations all over the site. So we worked with our regulators. We developed a plan. We showed them the plan, and we got to work on it quickly and avoided penalties, but we did not avoid the cost of compliance. Got to consider what was here in the past. This is a cute little women's purse clothing store in Winston-Salem. If you'll notice in the background, underneath the canopy, which used to be obviously a pump station, are 3 repair bays that are now, modern glass windows. You notice on the far left-hand side, there are outdoor bathrooms, which were obviously part of an old service station. So when using something like this as collateral, it looks good today, but ask yourself, what happened to the tanks? Were they removed? Did they get sampled? Did they get proper closure? Here's a great case that we had probably about 10 years ago, a company called Education Station that we foreclosed on. The realtor showed the property in the winter. It was a very cold January. The pipes burst and water flooded inside the property because the realtor forgot to turn the water off after showing the property. The mold damage was extensive. We spent $150,000 in mold remediation, and we sold the property for less than $150,000. This was a daycare that had gone under, and it had market stigma involved in it as well. Imagine trying to resell a daycare that was impacted with mold. Whether the mold is gone or not, you're still going to have a stigma issue. You can see the signs of the murals, Jack and Jill climbing up the hill, still on the remaining drywall while the rest of it was ripped out. All cabinets, furniture, toys, carpeting were all ripped out and thrown away. So hopefully we've given you guys some information to think about. We've given you some why a program is important to a lender, because it's looked at by the Fed, by the OCC, and other regulatory agencies as necessary, because lenders have risk, because our borrowers have risk. We've gone over what are some of the key components, and then we've discussed also how to implement some of those. So hopefully you found that entertaining. Hopefully Michael and John were able to provide you some good insight into how they run their programs. Now we're going to turn it over to questions received that have been submitted to the EBA. Georgina, over to you.
Okay. I have a couple of questions if we don't have any from the audience. The first one would be, how has your program changed over the last decade? Meaning effects from the 2008 downturn or from Dodd-Frank legislation? And so maybe we can get an answer from all three of you. John Rybak first.
Oh, great. Over the last decade, I think one of the things that we've learned, not just from the recession and the downturn, which that increased our volume tremendously. When you increase volume but not staff, you've got to learn how to be more efficient. So our program has become much more efficient, much more consultant reliant. That's where the training comes in. That's where the relationship comes in. But we have to move faster. Back pre-2008, I think we took a lot slower look at things. We got a lot more hung up on things like heating oil tanks and stuff like that. So we've tried to be more efficient, more effective. Trust our business partners more, et cetera.
John McGinnis.
Well,
how has your program changed?
Well, I think the actual environmental risk, the policy and program has pretty much stayed the same. Maybe it's reflected an increase in property value as we came out of the recession. And the number of loans definitely increased. Our staff has stayed about the same. So we're just, as John laid out, we definitely rely on consultants, to do the legwork. But that's the only change I can see.
And Michael Cole?
Yeah, well, certainly when I first came to SunTrust, we were just creating the environmental department. So before that, we had appraisers that our appraisal staff would both order the appraisals and the environmental reports. So we actually created an environmental division of that department and started bringing on environmental professionals and specializing in just doing the environmental due diligence or environmental risk management. So the change has been immense for us, but it was also a growth period too. I mean, we started out with just 2 people doing the environmental due diligence for the bank, and we've slowly expanded till now we have a staff of 6, which is still a small staff, but it certainly shows that there's an investment into doing environmental risk management that wasn't there when we first started.
So continuing with Michael Cole, what kind of internal staff training does your bank do?
Yeah, one thing I would love to say that we have an immense internal staff training program, but we really don't. We encourage our staff, and our staff oftentimes will do due diligence at dawn programs that are put on, around their areas, or they'll come to a conference or attend seminars, or do their continuing ed for their geology license. But we don't really have as small a program as I'd like to have. I would love to see us have a more formalized training program and continuing ed program for our bank and moving forward, but we just haven't developed that yet.
So, John, either of the Johns, do you have a comment for internal staff training also?
Well, other than I think we're all attending Environmental Bankers Association webinars and conferences as much as we can, and we stay apprised. There's no formal training though in-house for us. We provide training to the loan groups as part of our mandate for the bank. So they're educated on environmental risk before an issue happens. They'll know why we're here and what we do. So that we provide the training ourselves to the loan groups. But for the staff, yeah, we just stay apprised of what's changing in the industry. We get that from reading the reports as well and talking to our consultants and seeing what regulations are maybe coming down the pike or changing.
So do any of you who are on this call outsource some of the tasks that would typically be done internally by an ERM department?
Yes, Georgina, this is John. If I could jump onto that training, because I did want to add something, and then I'll answer part two, the outsource. So training it's a real big deal for us, and I know that we're routinely hitting, promotional for EBA, but there's nothing else out there that I can experience for my bankers or my risk staff out there that could compete with that. So getting them to rub elbows with John McGinnis and Michael Cole at these events and hear this stuff is huge. So I try and send them, routinely send to each event one of them and rotate it around through. That's huge. We also do two other things. We send out our junior staff to the field. So we basically said, hey, go out and follow somebody doing a phase one. Go out and follow somebody doing a phase two. I've even had them do hand augering, and they don't really like it, but it's just the point of getting out there and understanding the process. We also do 4 times a week, 1 half hour, we do deal time, where we throw a deal on the table. You have to present the deal, the risks, and how you would handle it, and then you try and get consensus or listen to dissenting arguments. So we actually debate on it, and the whole purpose for that is to relate to each other, number one, but number two, to get us some consistency on how we handle and look at risk. So I think that's been a real key for us, especially when we got 2 remote employees now. That's been a real key. As far as outsourcing goes, so thank you for letting me back up on that. As far as outsourcing goes, yes, we outsource 20% of our reviews to 3 different outsourced firms, and we include those outsourced firms in our deal time so they can also calibrate and get consistent and get familiar with us and be part of the team. And they do everything we do, from reviewing the reports to talking to the consultants to talking to the bankers and borrowers and even engaging reports on our behalf.
Michael Cole or John, one of you to answer that question also about outsourcing. Do you use outsourcing?
We rarely do outsourcing. Yeah, we rarely use outsourcing. Yeah, we could. So far, we've been able to handle with our staff in-house the number of reviews we're going to get. That's not to say there are occasions like a large portfolio where that will be required.
Okay, I've got a couple of other questions coming from the audience. One of those is, how do you handle balloon payments or renewals on outstanding commercial loans? Do you do a new environmental assessment?
This is John. So the way we've tried to do it is very simple. We recommit to what we already committed to. So if it's a $2 million original note, if they're doing a refi up to $2 million, we don't require anything new. If they are increasing the exposure, then this is a deal bigger than the last deal we did. We redo the environmental due diligence.
And if I can add to that, one of the other advantages of EBA is that we're able to do large surveys of our bankers. We did a survey about a year ago where we had 50 banks respond. We categorized them by size of the bank. That information is available to people. And one of the things we found was what John just said, that additional advances, pretty much everybody was requiring new due diligence when there was more money being lent. So I'm going to go to the last question, which is, I see subsurface investigations that are not signed and stamped by a licensed professional quite often. Do you check the credentials of the report writer or firm when requesting reports where a stamp would be required?
Well, we've required the stamp, signature and stamp, yeah.
Yeah, this is Michael Cole. I was just going to say that we do require that their credentials and their bios be included in the report, and we do check to make sure that they meet the minimum standard required in that state.
Okay, I think that's all the questions that have been submitted. And if anybody has any other questions, one of the attendees, feel free to email it to the Central EBA office, and we'll get an answer back to you. Thank you very much for attending. We will in the future be doing a Environmental 102, which will answer some of the questions about exactly what would you put in your policy to fit with your risk tolerance, as well as other topics. Some of our upcoming features will be for members only, and some will be available to the public, just like this one. Thank you very much for attending. Bye.
Thank you.